So in this video, we're going to talk about the dividend capture strategy, and we're going to get more into detail about how this strategy works and how you could potentially make money purchasing a dividend stock right before what's called the X day, which we'll get more into that. And then you can sell the stock actually on the X day. So essentially, you could hold the stock as little as 1 day and still receive the dividend. And there's going to be some caveats and some things to consider here, but nonetheless, let's get into this and talk about the dividend capture strategy. And the first thing you're going to want to look at is the ex-dividend day. And so this is the day that you are no longer entitled to receive the dividend if you purchase the stock. And so each stock, before the dividend's actually paid, will have an ex-dividend day. And that is essentially the day that if you purchase the stock on the ex-dividend day, you will no longer receive that dividend. And so I'll give you an example. Let's say a stock has an X day of July 18th. Just as a hypothetical example, they pay that dividend, let's say 2 weeks later on, let's say August 3rd or August 4th. Well, on that X day, if you purchase the stock, you are not going to receive that dividend. Now, if you purchase the stock before the X day, so you can purchase it 1 day, that second bullet point, before the X dividend day, you will receive that dividend, even if you sell the stock the next day or on the X day. And so that's an important consideration, because you could essentially hold the stock for as little as 1 business day or even a few hours, right? If you purchase the stock in the post market or near the market close and then you sell it the next morning, you're still going to receive that dividend. Okay, so just something to keep in mind. But if you purchase it on the X day, then you won't receive that dividend. So very important to keep that in mind. In other words, the third point on this list here, the person selling stock on the X day will receive the dividend, but the buyer on the X day will not receive the dividend. Thus, 1 business day before the X day is the cutoff for buyers of the stock to purchase it and still receive the upcoming dividend. So that's regardless of when that dividend is paid. So even if the dividend is scheduled to be paid out 2, 3, even 3 months down the road, which is typically not the case. Usually it's like a couple weeks or so when they actually pay out that dividend. But if you just, you were to trade this, for example, let's say you were to buy, right before the post market, let's say at 7 p.m., that was the day before the ex-dividend day, then you sell it in the pre-market the next morning, you're still going to receive that dividend. It doesn't take into account pre or post market. It doesn't take into account regular market session. You could hold the stock essentially for a few trading hours or less and still receive the dividend. Okay, so then this gets us into what is the dividend capture strategy? So this strategy involves buying a dividend stock the day before the ex-dividend day and then selling it on the ex-dividend day or shortly thereafter. So, that cutoff, right before the ex-dividend day and then sell it, that's like the minimum you can hold the stock for, is that 1 business day period, even if it's only for, a couple trading hours or so, it is still the cutoff there. So by doing so, you hope to capture the dividend and sell the stock shortly after. Ideally, the price of the stock does not move or even goes up, and you walk away with a break even on the share price or even a profit on the share price and the dividend in your pocket. Now, one consideration, which we'll get more into here in just a minute, is that when it comes to the dividend capture strategy, on the X day, right, this is how it's supposed to work, and this is where the arbitrage opportunity comes in, right? But it's supposed to work like this. Let's say a stock is expected to pay $1 dividend, right? That's the declared dividend. So on the X day, the stock will drop by $1 per share, all else held equal. So essentially, you have a stock that's traded at $50 per share. It's 1 day before the X day. Okay, so it's $50 at the close, 1 day before the X day. The dividend is for $1 per share. The next day, that stock is supposed to drop to $49, and thus that's supposed to prevent any kind of arbitrage opportunities. But nonetheless, that's not always how it works, and that's where your opportunity comes in with the dividend capture strategy. So even though it's supposed to drop by $1 on the X day to prevent any kind of arbitrage opportunities, of course there's other market factors involved. There's news that could come out, earnings. There's market sentiment, right? What's the general trend of the stock? Are we in a bear market? I mean, is the stock going down? Has it been in a downtrend for a while? Or has it been in a sustained uptrend? That's something to consider, because that's where this strategy can really come into play. With all those different factors involved, it's not just as simple as the stock dropping by the amount of the dividend, because that doesn't always happen. So key considerations. In general, on the X day, the stock should drop by the amount of the dividend. For example, a $25 stock, I have some misspellings there, paying a $1 dividend should drop to $24 on the X day. So just as I was describing. So, as I was saying, it's not always the case. In fact, I would say most of the time, even though the stock is supposed to drop by $1, there's other factors involved than just the dividend. So even though, at the open, right, you might, on the X day, you might see it drop from $25 to $24. Well, keep in mind, there's other traders in the market too. So there's other, they're buying and selling for all kinds of different reasons. So just because it drops by $1, let's say it goes down to $24, but let's say, by the end of that trading day, the stock is at $24.50. Or maybe it's even back above 25 because the stock had good news. So that's the main thing to keep in mind, is that you're not going to see just a drop down to $1 and that's it, in the share price. There's so many other factors involved with this. But the third point here, by implementing this strategy, a trader/investor is looking for an arbitrage opportunity and to walk away with a profit by selling the stock for more than the amount of the full dividend drop. And so, as I was saying, a stock pays a $1 dividend, but let's say you were you're able to sell the stock at $24.50 the next day. Well, you're still going to receive that 50-cent arbitrage because, the dividend was $1 and you took a 50-cent loss on your capital, but that dividend, when it comes in, you'll get that full amount of the dividend no matter what. And so that's your profit right there, would be 50 cents, not the full amount of the dividend, but 50 cents per share. And so the last point here, this strategy works best for dividend stocks that are already in a consistent uptrend and momentum is on your side. And so when it comes to, momentum and the stock market, what you're looking at is, if a stock, like I said, was in a sustained bull market or a bull trend, I should say, and let's say the market consensus is generally bullish, that stock might drop by $1, but by the end of the day, because let's say the S&P 500 rips big time and the stock's part of the S&P 500, well, that stock's most likely going to participate in some of that upside for the S&P 500, regardless of the fact that it dropped by $1 because of that dividend on the X day. So, just another consideration there. So here's an example of the dividend capture strategy. I know we kind of already went over this, but let's do another example just so we can get a better feel for it. You purchase 100 shares of XYZ stock, which was last traded at $25 per share one day before the ex-dividend day. XYZ is scheduled to pay a $1 dividend to shareholders on the payment day. The next business day, or the ex-dividend day, the stock falls as expected by the amount of the dividend. However, good news comes out and the stock finishes at $24.50 that day. You manage to time it perfectly and sell your stock at $24.50, thus collecting a profit of 50 cents per share, bought at $25 minus the $24.50 sell price, plus the $1 dividend received is a 50-cent total profit per share on 100 shares equals $50 profit in your pocket. So kind of just the same example we were going over there. And let's go ahead and take a look at some live examples now. So what we're going to do is go over to TD Ameritrade and a couple other websites here. Let's see. Or you know what, actually, instead of going to TD Ameritrade, probably the best thing I can do is show you, just like an example of this in motion. So, let's take a look at Procter & Gamble stock. So Procter & Gamble is a stock that regularly pays dividends. They're what's called a dividend aristocrat, which means they paid dividends for at least 25 years. And I think they might be a dividend king, actually, which means they paid dividends for 50 plus years. But if we look at the most recent dividend history for Procter & Gamble, we can click on this here, and hopefully it loads. But you'll see like the X day here, even if it doesn't load, you can see 7/21/22 was the X day, right? So that was the most recent X day. So you could have purchased on 7/20 and then sold on 7/21. Now we can also take a look at like the chart of Procter & Gamble because we know when the X day was. That's probably the most important thing we can do actually is take a look at the chart on Procter & Gamble. If I get my Thinkorswim pulled up here, we can go ahead and open that. And let's go over to the charts on Procter & Gamble. We'll look at exactly what happened on that day, right? Where did the stock trade at? What was the low? What was the high? Having some trouble here with my internet. It's going a little bit slow, and so hopefully we can get this to load. I might have to put this on pause just for a minute. I'll be right back. Okay, so I was able to get my dividend or my internet to load here. So let's take a look at some of the dividends here. So you'll see the X day was on 7/21. So you could have purchased on 7/20 and then sold it on 7/21 and still receive the dividend, which was 91 cents per share, or 0.9133 to be exact. The payment day was on 8/15, so even though that was 3 weeks after, you didn't have to hold that long. You could have held as little as 1 business day. So let's go back over to Thinkorswim. If my computer will load, here we go. Okay, so you'll see on, let's see where it's trading on 7/21. Let's find that specific day here, and we can look at the day on the bottom, which it looks like here was, let's see, 7/21. You'll see the stock actually went, so what you can see here on that day, right? You purchased the stock on 7/20. Okay, now the stock did finish down that day, but you know, it looks like here it actually might have finished, let me see. No, it finished green, I'm sorry. So my mistake. But you'll see the trading range here. So you could have purchased up here. And, you know, even if you didn't sell the stock on the X day, you'll see that there was an uptrend here where the stock actually went up, right? So it's not an exact science. So you'll see that like on 7/21, the high of the day, it looks like, was $140.91. The low of the day was $138.87. Down here, right, $140.40, and then $144.06. And so that's the risk you're taking with this strategy. Now, this is not my favorite strategy. This is not something I do personally. But I know some people have done it, and some people are able to have success with it because they can time their entries and exits, you know, with precision. And I had a guy when I worked at TD Ameritrade who, you know, he was doing this strategy, and, you know, he would call in sometimes and I'd get him on the phone, and he was doing it pretty successfully. And I remember the last stock he did that against was, I think, Devon Energy, which he made out, you know, pretty good on that one because the stock had been going up, and, you know, he had captured that dividend. And so this just gives you an idea, like, you know, even if you were to sell this stock a few days after, like you could set a limit order, you know, where you try to sell the stock at a specific price. So let's say you got in at like 145, right? And then the dividend, or this was actually, let me see here, 7/21. So here's where we are. I was on the wrong part of the chart. So, you know, you could have bought the stock at, let's say, 141. And then, you know, if you would have waited 5 trading days or 3 trading days, you'll see that we got to rip up to 143, 144. And so, like I said, it's not an exact science. Although the stock did drop when that dividend was, you know, the X day came out, look how it rallied back. So that kind of gives you an idea of what can happen. It's all about ultimately market sentiment and what happens with that. And so when you're looking at, you know, when I say market sentiment, it really is more stock specific. Like market sentiment is one role, but as I said, like there's news that can come out. There's all sorts of things that can happen that can cause the stock to go up or down for that matter. And so that's just a consideration. So even though the stock is supposed to drop by 91 cents, it's not an exact science, and as you'll see, we had a pretty good uptrend. So even if you bought this stock here and held on to it for, you know, 5 or 6 days, you could have made money on the upside, and on top of that, you could have gotten the dividend, or, you know, even just broken even a couple days later. If you bought at 141, it hit that level, you know, pretty much just a couple days after that. So you would have held the stock for 2 days after, and then of course, you would have gotten that dividend. So that's just one example of how this can work. Like I said, this is not my exact strategy, or this is not my favorite strategy that I like to use. I've never actually used it, but it's one of those things where a lot of people do find value in it, and they do get, you know, like they're able to time it pretty good. And so for those active traders out there who are looking at a way to, you know, potentially make some passive income, this can work, right? But just like any other trading strategy, there's going to be more risk involved, like with day trading, with swing trading, and all that kind of stuff. It's just not something I like doing personally, but you know, it's all up to your risk tolerance and what you're trying to accomplish. So the dividend capture strategy, to summarize here, is an arbitrage trading strategy that can be used when trying to collect a dividend, sell the stock shortly after, and come out ahead. Even though the stock price is typically expected to fall by the amount of the dividend on the X day, this is not always the case, and many times the stock can make a sharp rebound shortly after the dip from the dividend in a strong bull market. And this second point here I think is really important, because look what happened, right? It did make a strong rebound. You would have bought this stock at, let's say, 141 or even 143, and if you would have held just a few days, right? I mean, you're up to 147, and then look what happened after this. It had a sharp gap down, and then, you know, it came right back up to 149. And so Like I said, it's not an exact science. And so if you're looking at a stock that isn't a bull trend, right, even if it's short-lived, this one, has been selling off lately, but at the time, it was going up. And so specifically in a sustained bull market, though, where the stock continually is going up and doing well, or the stock just has good news and stuff, that's really what you can, look for with this strategy. But I would say, this can also be considered what's called a dividend day trading or swing trading strategy, depending on how long the stock is held before moving on to another stock to try to repeat the same strategy. If you're selling the stock within a week or two, it's called more like swing trading. Dividend day trading would be, or I guess overnight trading would be like, still technically a swing trade, but you get the idea, right? You sell it the next day. So really that's kind of the way I think of it. But the primary risk here, and this is the most important consideration I think with this strategy, is that the stock takes a big dip, and let's say you didn't really want to buy the stock in the first place. Let's say you're just chasing that dividend. I mean, if you don't really like the company and you're just trying to trade it for the dividend, and you don't know anything about the company, and you don't really want to hold it or anything like that, well then it's just like any other trading strategy. If you're not really considering the fundamentals, well, the risk you're taking is that the stock makes a big move to the downside. So I mean, if you collect a dividend of $1 per share, but the stock goes down $5 per share, and now you're down on your position, and you can mitigate this with what's called stop losses. So you can use a stop loss to limit your downside, and place a stop loss. Let's say if the stock is at 25, you buy it at $25, and then technically the stock would drop to 24. You could place a stop loss at $24 per share to try to get out at that price, so you'd at least break even. So that's one thing that you can do. And then of course, if the stock never touches 24, but let's say it just goes up the next day, then you can sell it for a profit. So that's one thing I would strongly consider with this strategy, is using a stop loss, right? If you're just trying to capture the dividend and you don't care anything about the company, which is going to be typical with a strategy like this, you're just trying to day trade / swing trade, I would definitely use a stop loss, and try to mitigate those losses, because if you're doing this continually, it can add up quick, and you're not going to capture every dividend, quite simply. So I would place that stop loss and be careful on the downside. And then on the upside, if you're able to consistently do this and, even make 20 cents, 50 cents profit, on a $1 dividend, that's pretty good, right? That you're capturing that kind of dividend. So anyway, guys, let me know if you have any questions about this. It can definitely be a good strategy, but not for everybody. Like I said, it's not something I personally do. And I do know people who have done it, and some people who have done it successfully, but you just have to keep in mind your risk reward and the potential for profit and loss. So nonetheless, guys, hope you enjoyed this video, and I will see you in the next one.